Hey, what's going on, guys? This is Blood Phantom 81. Thank you guys for checking into my channel. Today, I'm very happy to walk through my defensive portfolio. So I've had this portfolio since May 29th, 2018, so probably like 4 months ago. I will say that this defensive portfolio has gone through a lot of changes. First, I had a strategy of getting weekly dividends, so I bought weekly dividend stocks, that kind of thing. Got rid of a few of those. And I've definitely just focused on a few names. So overall, this portfolio has maybe something like 20-ish holdings. We can even see right here just how many holdings I have. But it took a lot to actually narrow it down. So each of these holdings I consider very important. They all play a role in the portfolio. So let's go ahead and take a look at how many holdings I have and etc. High savings. Okay, so it's about 20 holdings, so very slim. Starting yield of about 2.9%, but all of these increase their dividends year after year. They're not all aristocrats, but ideally they would do something like an aristocrat would, and they would increase their dividends every single year, regardless. So you get an increasing yield on cost because of that. So first of all, the motivation for a defensive portfolio is because you want something that will keep your portfolio stable. That's one reason, actually. And essentially, when you have periods of extreme market volatility, like we've had over the last, ever since October, a lot of these defensive stocks haven't actually done that bad. If we take a look at something like Procter & Gamble, Procter & Gamble has been killing it over the last few months. Ever since May, it's just been on a huge tear. Awesome buying opportunity right there. I did buy Procter & Gamble around that time, and that's why I'm up 31% on Procter & Gamble, which I'm very happy about. Same thing with Clorox. Clorox, Procter & Gamble have been the two, I guess, best performing stocks in this portfolio, absolutely crushing it in times of market volatility, and I consider them to be very stable. So I like that low volatility thing. But the other thing about these stocks is something I mentioned earlier. You want something that's going to give you a secure dividend. There's high dividend stocks, which I think are great for something like M1 Finance, but you may not be able to rely on their dividend even during a recession. So these are very blue chip stocks. These are very big boy stocks, not very speculative, that kind of thing, which I think is super important for a portfolio. So very happy. I'm very proud of this portfolio. Only 20 holdings. Each of them means something to me. So I want to walk through some of them, not all of them. And yeah, so stick around and hope you enjoy the video. And yeah, let's get into it. So I have about 1.4K in this portfolio. So I expect that to be double that in a year because I do daily deposits, excuse me, on M1 Finance. So I expect that to double by next year. So that plus the yield that I'm getting, which is around 3%, let's just say 3%, I think this thing is going to grow pretty quickly. So starting off the list with Clorox, once again, has been absolutely crushing it over the last few months. Has actually made a higher high relative to the high here in late December or late 2017. So clearly after 2017, we had some kind of consolidation, which the rest of the stock market did as well. And even around maybe March, a lot of tech stocks were starting to recover, but a lot of consumer staple stocks didn't do too well. So still kind of in the gutter, even around April, even around May. But from May on, Clorox and Procter & Gamble and other stocks just absolutely crushed it. So Clorox found support here around the 200-week moving average, bounced off of that, and now we're back to the all-time highs with Clorox. I definitely love this one. Dividend yield of about, maybe 2-ish%. Yeah, 2.35%. That's awesome. I love that. So very happy with Clorox. Moving on to Pepsi, another high flyer at 15% ever since May. And by the way, I made the conscious decision once I saw that a lot of these stocks were on a discount around May, and that's why the portfolio was started around May. So I saw that there was a lot of good buying opportunities. I knew it wouldn't last forever. especially with blue chip stocks like this that are increasing their dividends. So Pepsi was a no-brainer. Another CPG kind of consumer defensive stock. Absolutely crushing it since May. Very happy with this one. And I can definitely rely on that. I like Pepsi, I like Coca-Cola, but I don't want to have them both. And Pepsi just felt like a little bit better of a bet. I like the capital appreciation a little bit more. Something like Coca-Cola kind of just goes sideways, which is fine if you only care about dividend income. But I'm still young. I still want to see some capital appreciation. And so Pepsi is a little bit more for me, for my style of investing. Next on the list is Procter and Gamble. Procter and Gamble comes as another large part of my portfolio. Dividend yield of 3.07%. Awesome dividend yield. And one thing you'll know is I basically have 4 stocks of a 7% allocation, and so those are my favorite. Those are my mains. Procter and Gamble, Pepsi, Clorox, all of them I love to death. That's kind of dramatic. I love them a lot. I shouldn't say I love them to death. But Procter and Gamble, I just mentioned, ever since May, just absolutely taking off. So that's something that I definitely like. I do think that for a lot of these, they've been performing so well since May. It's possible that we'll get some kind of consolidation pretty soon, but that's fine with me. Anything like this, any kind of dip on this, I'm very happy to get. Whereas something like a tech stock, it's a little bit, anything that doesn't pay a dividend, like if I were to buy a tech stock, I would feel less good about buying the dip necessarily because you get nothing for owning that stock. Something like this it just feels a lot better. So yeah, definitely learning a lot about dividends and kind of changing my thinking of how I think about investing. All right, so next on the list is a healthcare stock in Pfizer. So ticker symbol PFE. A lot of people don't invest in this stock actually. Market cap of $250 billion, which is I think maybe like top 25 in the S&P 500. So very large stock. Huge product line surprisingly for a healthcare stock. And dividend yield of 3%. So if it has a dividend yield of at least 3% and it has the defensive status of staying strong even in times of market volatility, I gotta go for it. So Pfizer, another high flyer, and I'm up 13% on this one, showing a bit of consolidation. So if you guys are thinking about getting into Pfizer, 52-week high is at 46, currently right now at 43.92. So maybe would be now would be a good time to dabble into it. But I wouldn't be surprised if we consolidate a little bit higher. The move here since May has been pretty large. Once again, May has been awesome for these defensive stocks. So yeah, I like Pfizer a lot. Now, I want to give an introduction to this next one. So this next one is Kellogg, right? I'm down 17% on Kellogg. And there's a few stocks on this portfolio which I understand that the level of consolidation on these has been a lot more than some other stocks. I understand that. I'm mostly concerned with dividend yield itself with stocks like these, and I'm willing to take that risk because over the long term, I believe in something like Kellogg or another blue chip stocks like Kraft Heinz, which I'll also talk about in this video. So I gave myself the liberty to, I guess, splurge on stocks that are currently on discounts, even if it's a multi-year consolidation, because I'm concerned with dividend yield on some stocks, and on some stocks, I'm concerned with capital appreciation. However, I still think that Kellogg will at some point recover from this period of consolidation. Let's go ahead and take a look at a monthly time frame. When you zoom out, things do not look as bad. Okay, we're still above the 200-month moving average, and both the 50 and the 200-month moving averages are sloping upwards. So we have this level of support. Every once in a while, Kellogg has to come down and retest these moving averages. So it did here in the 2000 recession, once again in the 2008 recession, and once again right now we're seeing a pretty kind of heavy period of consolidation. But guess what? Because Kellogg increases their dividend throughout this entire period right here, if you're scooping up shares, you're increasing your yield on cost because they're increasing their dividend payout. So Kellogg is currently sitting at around $60 a share. And like I said, we've been consolidating since July 2016. So that's over 2 years now without a higher high. And from the high to the low, we've lost about 29% of its value. So with Kellogg, you have to think about dollar cost averaging, and you have to be okay with maybe being down in the short term. Kellogg currently offers, let me go ahead and take a look at their dividend yield. So Kellogg is a 3.6% dividend yield, so that's about 0.6% more than the other ones. Over the long term, that makes a pretty big difference, especially if Kellogg continues to stay down. So I like Kellogg for the long term, and I like Kellogg for the dividend, and I like Kellogg's product line. Next stock on this list is Costco. So Costco, surprisingly, used to be doing better. I'm currently up 6% on Costco. But it's been kind of slowing down over the past maybe couple months. Let's go ahead and take a look at a weekly time frame. It's just been going nowhere. So May was when a lot of these consumer staple stocks did really well. So once again, with Costco was no exception. So since May, Costco has been kind of taking off. But ever since then, we've just been slowing down ever since September, which I'm fine with, honestly. It's okay if a stock has to wait for its moving average to catch up. That's totally fine with me. And Costco is clearly not scared of, getting its business taken from, online giants such as Amazon and other large retailers such as eBay. Because in terms of wholesale, Costco is definitely the way to go, especially in the United States. Just has a very great sentiment all around. And so I like this one for the long term. I like this one even if it was just like a swing trade. So I do think that Costco serves multi-purpose. The dividend yield isn't the best as far as I as far as I remember. So dividend yield is at 0.98%, which is kind of why I implied it's kind of good for swing trading as well. So the dividend yield isn't. If you're interested in dividend yields, I would kind of rethink Costco. And I'm not super sure about their dividend growth rate as well, so I don't know if that's going to continue to grow even faster. But I do like it for its capital appreciation, and I do like it for its stability. So if you zoom out a little bit and take a look at Costco on the weekly time frame, where's the dip? The 2008 recession. Let's go ahead and take a look at a monthly time frame. Yeah, every once in a while it's going to see a recession. It may lose around 30% of its value, but for the most part, Costco is a very safe bet if you want some low volatility stocks in your portfolio. So I'm liking Costco, and I'm liking Costco going forward. The next stock on the list I have a lot to say about is Constellation Brand. So another one with not a great dividend yield. It's currently around 1.5%. The reason why it's 1.5% is because of the dip that we've seen lately. So around the top, maybe a couple months ago, Constellation Brand paid like around 0.5% of a dividend yield. But because it was such a high flyer, I do think it was a time to see some consolidation. The last time we tested this 200-week moving average was here in 2012. So coming back, getting pretty close to it. Constellation Brand still has a ton of cash. They're still making major acquisitions. They're experimenting with getting into cannabis as an investment because cannabis may be more mainstream in the future going forward. And I do think that. And that's why you see companies like Altria buying, I think it was Kronos, or investing in Kronos and that kind of thing. So the forefront, the front runners of cannabis, I think, are going to definitely benefit in the long run. So I'm okay with Constellation making some more outlandish investments. And this is kind of one of those stocks that it's rare that we see a dip. I mean, let's be real here. Taking a look at a weekly time frame one more time, it's rare that we see a dip of this magnitude. And Constellation Brand, the 52-week high is here at 235. We're currently down around 19%. So it didn't benefit like a lot of these other consumer staple stocks. It didn't benefit in May, in the month of May of 2018. But that's fine because it's a high flyer, and we know it's a high flyer. And when there's a dip like this, it's important to take advantage of it. So I'm liking Constellation Brand, and I'm totally fine with being down on it. This is not me being an investor and saying like, yeah, my stocks are down, but I don't care, whatever. I feel pretty good about Constellation, even if I'm down down 23%, because I don't know when the dividend yield is going to be 1% again. So I'm fine with getting in now. Next stock on the list is Kimberly Clark. So Kimberly Clark, I love, but the reason it's not a 7% kind of holding is because I don't see it's. I mean, the reason why I would get into something like Kimberly Clark is for a few things. Number one, I like consumer packaged goods stocks. I like the CPG thing, but I already own Procter and Gamble, and I like Procter and Gamble's product list a bit more. And the other thing is, Kimberly Clark just isn't as strong as Procter and Gamble. They don't do as many share buybacks. They don't get as much money invested as Procter and Gamble. However, if we take a look at Kimberly Clark's dividend yield, it's currently around 3.5%, which is I think a little more than Procter and Gamble. So if you're interested in yield alone, then I would probably consider making Kimberly Clark maybe the same allocation as Procter and Gamble, but I don't want to be over leveraged in CPG. I love CPG, but I don't want to overdo it. And I want to give a shout out to other industries. The next stock I'm moving into is Johnson & Johnson, which I just purchased last week. Johnson & Johnson surprisingly pays a 2.47% dividend yield, which is not too shabby. I was expecting something closer to 3. The thing about Johnson & Johnson as well is it is a CPG stock, and it also benefited from the May kind of bounce that a lot of consumer staples did. So Johnson & Johnson on long term, we've heard this story over and over again. It just needed to find support around here at the 200-week moving average. Everything looks good for Johnson & Johnson. All systems are set for another leg higher. So I'm very happy to get into this one. I'm surprised it took me this long to get into it. It was kind of like, it felt like something was missing. And so I kind of just had to jump on this one. I did get in a little bit late, which I'm not too happy about, especially because I was making videos about this one here in early 2018 when we were just trading against this range. So essentially earlier in 2018, we were in this downwards kind of resistance line and just butting up against it, getting rejected off of it until finally we just broke through it and we never looked back. So Johnson & Johnson I feel awesome about. And the next stock I want to talk about is finally the first industrial stock that is on this list. So this stock is 3M. Now, 3M I made an entire video about. You guys can check out my Dividend Kings video. That's my last video. So I don't want to talk about it too much. I will say, number one, I wanted some exposure to the industrial side of investing. Number two, awesome discount right now. It's rare that we see discounts like this. The last time we saw a discount of this magnitude was in the summer of 2015 when the entire stock market corrected. So what we see right now is another correction, which I don't know how much longer it's going to last. So it's a discount. It's a fire sale. I had to jump into it. So I'm very happy with dollar cost averaging into it. And this one increases its dividend very, very quickly. So I'm excited to be a 3M shareholder. Next stock on the list is Caterpillar. So Caterpillar recently took a huge hit. I'm talking, share price was around 170, and that was here not even too long ago, just at the start of 2018, and it lost about 34% of its value. The initial kind of scare was, I believe, well, actually, I don't have to guess, I could just tell you, was here in September. From September all the way to October, Caterpillar lost around 28% of its value, which you don't see with the stock like Caterpillar. Maybe Netflix, you see that? Yes, you see that all the time. Amazon, yes, you'll see something like this, but not really Caterpillar. So I am down on this one, but I'm perfectly fine with dollar cost averaging. Because it took such a hit, my portfolio or M1 Finance just automatically started putting more money in there as I was depositing more money. So I'm still catching up to this 5% allocation. I'm totally fine with being a Caterpillar shareholder. Dividend yield at 2.68%. Anything over 2% and an industrial is something that I'm very happy with. So yeah, and then moving on to Kraft Heinz. Very, very similar story to Kellogg. So Kraft Heinz is also, honestly, it's actually relatively new. At least on TradingView it is. I don't know how long it's been around as a company, but ever since 2017, we've just been going lower. And to a lot of investors, it may seem like the end is not in sight, and I totally understand that. It's funny because when you think about a blue chip defensive stock, you don't think about something that you're allowed to gamble on. But with Procter and Gamble, Kraft Heinz, I felt perfectly okay with gambling on this one because I know that it's going to continue to increase their dividend yield. Dividend yield at a massive, massive 5%, and it's still going higher. It's still going higher because they still have the cash to do so, because their product list is also very impressive, in my honest opinion. So I'm perfectly fine with Kraft Heinz being in this consolidation period. I'm still going to continue to be a shareholder. Again, similar story is with General Mills. I gave myself the liberty to be like, you know what? Some stocks are going to be for this purpose, and some stocks are going to be for dividend growth. So General Mills, let's take a look at a weekly time frame. Obviously, things do not look pretty. Ever since the middle of 2016, just like Kellogg, ever since the middle of 2016, we've been going nothing but lower, lower highs, lower lows. But when you zoom out at a monthly time frame, okay, we're still above the 200 month moving averages, and both moving averages are sloping upwards. So General Mills, how much of a discount is this? This is almost a 50% discount from the all-time highs. So if General Mills will start to cut its dividend, that's, I don't envision that happening, but if that does, this might come off the list. However, once again, it's almost a 5% dividend yield, and I just couldn't, I couldn't avoid buying it. So this is a dividend growth stock, which I'm perfectly fine with owning. So yeah, next on the list is Unilever. I don't want to talk about this one. It's fine. It's a safe company. It's also CPG, which I've talked about a lot. Next few stocks I want to talk about is Roper Technologies, which a lot of people have not heard of. So Roper Technologies is one of those low volatility type stocks, massive high flyer. However, I did want at least one tech stock in this defensive stock or defensive portfolio. So Roper definitely made the cut. Roper has been increasing their dividends for at least 30 years by now, so I'm definitely fine with owning this one. And then next stock on the list is Wells Fargo. So I did want a financial stock. Wells Fargo actually pays a pretty nice dividend yield of close to 4%, I believe. 3.37%. Maybe it was a little bit higher once we were dipping. Anyway, so Wells Fargo has kind of been moving sideways ever since 2015. But for a dividend stock, I'm fine with something that goes sideways as long as the dividend is increasing, because it means you can scoop up more shares in the meantime. So Wells Fargo I'm fine with. It's a huge holding in Berkshire Hathaway, so I like this one. It's different for something like Visa or MasterCard, which I have in my aggressive portfolio. I'm fine with having something a little bit more, that sits in the back seat, kind of. The last stock I want to talk about, actually, or the last two, is Target. So Target, surprisingly, is a dividend aristocrat, at least. Pays a massive dividend yield of 3.6%, and capital appreciation. So it actually took a hit recently. So ever since the middle of 2017, May 2017, Target has been the high flyer. I think this is about maybe a 30% increase since that time period. But over the last 3 weeks, it's been a huge sell-off. And when I got into Target, actually, I sold United Technologies because I didn't want to deal with the mess of having the 3 stocks. I wanted to keep it to 20 stocks. And honestly, I'm not super convinced about UTX being an awesome investment. So something like Target, I'm happy to get into. And over the last 3 weeks, I think this is a gift. Target and Ross have seen the same kind of dip. I'm pretty sure whatever institutional selling pressure is happening with Target is also happening with Ross, because the chart is kind of uncanny. And so Target, I'm very happy to get into. I do think that they're making great strides in the online platform. I think their credit card is awesome. I think that the fact that they work with the smaller retailers, they're kind of like Walmart, and I'm sure they bully smaller retailers, but that's just kind of the way the world the world works. And it's one of the few retailers which actually might see growth for in-store purchases. So Target, I'm liking. And the last stock I want to talk about is AbbVie. I was fortunate enough to only get into AbbVie once I saw this dip. So AbbVie has taken a pretty big hit, honestly. So ever since the start of 2018, AbbVie lost a total of 36% up to around September or October. But now currently we're only at a 30% dip, which is still quite a bit. AbbVie is also a pretty old pharmaceutical company. They're at least an aristocrat, and from AbbVie came Abbott Laboratories, which is also a pretty good investment. But I wanted to stick with AbbVie. AbbVie currently pays a 4.74% dividend yield, and that's because of this dip. So with a few of these stocks, there is more urgency than others to actually get into them now. With Caterpillar, with 3M, with AbbVie, I don't know how much longer this sale is going to last. So we have to pick up as much shares as we can. And by we, I mean, I'm sorry, I'm just a very excited person when it comes to these stocks. But very happy with this one as well. So just to recap with this defensive portfolio, so I know that the return isn't great. I think honestly a lot of what happened here was with a company called Praxair, which I think it got acquired by something called Linde PLC. When that happened, I lost $40 and I never got it back. I haven't really questioned it. I haven't talked to M1 Finance about it. I just figured like it would go away, but it hasn't. So I might contact M1 Finance. But if it wasn't for that, this portfolio would only be down around $20, and that's including a very heavy period of volatility in the overall stock market. My tech and aggressive holdings are not doing too well on M1 Finance. I'll leave that for a separate video. I just wanted to keep this video on the defensive portfolio, and I'm sure it's already gotten pretty long by now. So that's where I'm going to end it. I hope you guys enjoy this video, and I hope you guys have a great night. Let me know what you think of my portfolio. Is it good? Is it bad? Give me critiques. Let me know. Have a great day, and good luck.